If you put, is it time to sell the equity markets into a Google search, you get 87 million news items around this item alone. And we're talking now about timing the markets, and we're talking about cycles, and it's certainly a way to get you insight into where the markets are and how they could perform in the near future. We're talking now to someone who has 30 years experience in financial markets and is the creator of the much watched Market Timing Report, or MTR. It's Andrew Pancholi, creator of the cycles analysis software system used to predict turning points in the markets. Andy, welcome. It's a pleasure to have you on today. And as I said, at the moment, this idea of selling the markets is uppermost in people's minds as an opportunity. But let's talk to you a little bit about this idea about cycles and looking at this cycle analysis. Explain, first of all, what it is. Are we talking short term, medium term, long term? How do you approach the subject?
Right. Hello, Jeremy, and thank you for having me on. Yeah, we start off at super long term. We literally look at several 100-year cycles, and we tune it all the way down into daily and intraday cycles. And the idea really is that human behavior repeats. Markets are, in fact, a reflection of human behavior. And what we're really seeing then is that if we can identify these patterns, we get a good idea of where the bigger moves work in both the equity and commodity markets, in fact, anything, and also in geopolitics. So the idea is that if we can get the bigger pictures in, and then we fine tune it, drill down using the smaller mathematical cycles, which we spent a long time, over 20 years programming, then we're able to identify big moves, often down to within a week or a day. And that's what we managed to do in 2020, and also more recently at the top just a few weeks ago.
Okay, well, let's use that and then put that question to you. Is it time to sell the equity markets? And clearly this is a topic of hot conversation at the moment. Applying your software analysis, what is it telling you at the moment and where we are within the current trading environment?
Right. Well, let's take a look. What I'd like to do is present you with a series of charts, and then perhaps
Sure.
The viewers can make their own minds up about what's going on. I'll explain how we can see the super macro cycles focus all the way down into the present state of the markets. Okay, so looking at the very big picture, here's the S&P 500, the cash S&P, and going all the way back to the genesis of this bull market, which was at the beginning of 2009. We're now 13 years in. Well, first of all, 13 is a Fibonacci number and a significant number there. More importantly, if we take this low and the 2020, the February 2020 high, and expand that up, we have recently over, since November, we've hit this 50% extension, 4,756. And that really has been providing us with significant overhead resistance. And whilst we've got this chart up here, if we do break out to the upside, although the odds don't favor that, then 5,078 will be a significant target. So point number one, the S&P 500 is at a significant level. Interestingly enough, when we look at the Dow, taking this low here in 2009, but this time taking this 2018 high, what we find is that the same concept has happened, and we've hit the 50% level. You'll see the Dow is very much lagging the S&P, because on the S&P we use this point here and this point here, and we've got the 50% level. So the S&P is ahead of that. But the point is, we're seeing dual resistance here, both on the S&P and the Dow. And let's take this one stage further. Looking at the 2020 decline, which is a short, sharp correction, and on the Dow, and taking that and expanding that by 61.8%, really gave us the high back there. And also, this is the overhead resistance. So there are three strong cases for overhead resistance. So this is standard Fibonacci, both in time and price. Now, what we do here is we also look for, let me bring this other idea in first as well. The presidential cycle, the 4-year cycle in the US markets, generally a good roadmap. It's quite coarse because it's a 4-year pattern. And this is basically the pattern of the market during the presidential year cycles. So we're in the midterm years, which is the blue line, and the blue line is this line here, and you can see that through January in the midterm year, the market tends to sell off into the back end of the month. And interestingly, whilst we've got this, as I say, this is a course roadmap. we tend to sort of see a sideways move and then a significant rally towards the back end of the year. And we might well see that rally, but there are other things we need to be aware of. As I say, this is a 4-year cycle that repeats. Now, we look at other cycles, and the 60-year cycle is an important one. It's basically 3 generations, 3 20-year generations. And what we found here when we were looking at this, we noticed that round about September, we noticed there was a strong case of the 2021 market following this 60-year cycle. And what we found was the market went up and then it went sideways. We got this little dip down here, which was represented here. And by the way, this is about pattern, not so much magnitude. We popped up here, a little bit of a breakaway from the pattern, but then we've picked it back up here. And this is the sharp decline. As I say, it's about pattern. And what we see here is it comes into a low at this point here. And that low there, this is the exact 1962 pattern, is sees a low on the 29th of January. And interestingly enough, what I'd like to point out is then we then see a rally into mid-March before a sell-off into the end of June. And there again, there's that end of year rally in that 1962 pattern. So this is the 60-year cycle. If we just go to the 80-year pattern, so again, another generation, we see a high there on the 5th of January and a low there just at the very end of April. And of course, 1942 was the war cycle. Let me bring in another one, which is the 20-year pattern. High on the 4th of January, so like we saw on the previous chart, and a sell-off into the 7th of February, then a pop-up into mid-March. So you can see the flavors are repeating, and this time a sell-off into as far as July. So there's something really interesting about these patterns for this year. First of all, as I mentioned, they're all decennial patterns, and they're actually in 20-year gaps. And basically, the 1942 pattern saw the war cycles. You know, we were America joined the Second World War in 1941. We're in the thick of the war. 1962 saw the Cuban Missile Crisis, 60-year cycle. Now, this is exactly what we're seeing right now, this escalation of the Cold War. Not only that, you know, we've seen geopolitics and these cycles, we could talk about them some other time, but just a quick overview is we have seen, for example, Britain, give up the sovereignty of Barbados. It's become a republic, but China is moving in there with great economic input, big loans and big infrastructure expansion. Barbados, it puts it within spitting distance of America. And of course, this week, Putin himself said he cannot discount the idea of putting missiles back into Cuba. So this theme is repeating very clearly. 1962, October 62 was a key point. And we also saw the Sino-Indian War there. That's another point that's been simmering away for the last 18 months to 2 years. And then 2002 had the war pattern of Gulf War II, you know, after 9/11. So this was quite interesting that these human behavior patterns repeat, and they're reflected in the markets as well, because a market chart is effectively just a demonstration of human psychology. So let's cut to the chase. It's all well and good knowing these super cycles, but how do you time it to trade it? Well, what I want to show you is how we hone these cycles all the way down, and we layer them into monthly cycles, weekly cycles, daily cycles. And here's a chart of a weekly chart of the S&P 500. And beneath this, this is not volume. This is our histogram system. And what we're looking at is for confluences of cycles coming together. And when we get a lot of these histograms spike. And the most important thing is that they're predictive. So we are forewarned of potential turning points. Do we know if it's going to be a high or a low? No, we don't necessarily. You know, we look for other information, commitment of traders data reports, etc. But the idea is that we know that to protect trending positions that into these time points. And very quickly, you can see this spike here generated this low, this one here, and this high here. This was the February 2020 high, which was very clearly indicated at the time, this low here. And most importantly, this recent spike gave us the top just at the beginning of the month. And so we were absolutely prepared for that, together with the other confirmation evidence of the Fibonacci levels being met. And basically what we're seeing is that there's another significant cycle set in July. So we've seen, you know, if you saw earlier, we did see some of these decennial patterns making significant lows in July. Now, I don't know if that's going to play out this year, but this is where the turning points are going to be. And we use them to give confirmation. So it just gives us an edge in trading. So the next weekly cycle is for the week ending 5th of February, which is next week. So it's there, but it's not a particularly strong cycle. Once again, you can see how these points have tied in with significant swings. And that's exactly what it's telling us, that to be on alert. And again, we're getting a weekly cycle there in July as well. So we're getting the confirmation of these super big cycles coming together. We hone these down into daily cycles, same concept again. And what we're seeing here, again, you can see how these points are identified. And we use a double set of these. So there are other set we use for confirmation. But most importantly, we have got here this turning point for the 26th to 27th of January. And it's a big spike. So I would anticipate a reversal there off the market. So that the challenge we've got right now is, given yesterday's sort of slight, I wouldn't call it a bounce, but we had an up day, albeit in a strong down market, as you can see from that bar there. So in the ideal scenario, if we sold off today and into tomorrow and the 27th, I'd be looking for a significant low there. But if we rally sharply later today and tomorrow, then we could be seeing a reversal to the downside. So this is a key point. The 26th to the 27th, it's very close to the 60-year cycle of the 29th of January, which you might recall from earlier on. But it also ties in, it's close enough to tie in with that 4th of February weekly cycle. So that is the overview of the cycles case for, it's a very quick overview of what we do. I mean, we go into much more detail. And then let me just bring up one other chart. We use a lot of technical analysis, and one of the things that works particularly well with market timing is the Andrews pitchfork. Many of you will be familiar with this anyway. But we find that when these, when the points of the pitchfork are hit and they coincide with a daily or weekly timing window, we find them very effective for confirming reversals and also for managing risk. And the key point here is that we did come all the way down to the median line and bounce off that. So we know the validity of this pitchfork geometry is very strong. And we are approaching the lower parallel, which typically would be a potential profit-taking opportunity for this first leg down. And of course, just from regular technical analysis, we'd be tying in with these old lows here. So we're making arguably a macro double bottom or even a triple bottom there. So that would be a certain point to bounce off. And if we got a rally back up to there, then that would possibly be a potential shorting point, but we would have to evaluate that as the market plays out. So we always trade the market rather than the forecast, but we use these bits of information just to give us an edge, Jeremy.
All right, well, let's pick up on that point and work out more about where we're going to go from this point. You've spoken about how you use Fibonacci's and the Andrews pitchfork, but talk to a little bit more about how you see the year going overall. We've got this opportunity possibly here to buy back into this little mini slump that we've seen. Whereabouts are we likely to end the year? Because if you have these dips throughout the year and then you've got this recovery, do you see the markets being better off at the end of the year than they were at the start?
Well, right now, that's a tough call, but the patterns do suggest for years ending in 2 that we will close up. In the decennial pattern itself, so if we look at years ending in 0, 1, 2, 3, etc., years ending in 2 tend to see significant lows, but the back end of years ending in 2 tends to see some rallies and bull markets. So, I think there's a good chance of a Santa Claus rally all the way towards the back end of the year. But before then, we have got some very big war cycles in. We've got very big conflict cycles coming in. And I think there are several wild cards here that we need to take into account. And that does suggest that, well, first of all, there are super cycles on the American economy. A 250-year cycle comes in, which does suggest America's power is likely to weaken more. And I think what we might see is the possible incapacitation of Biden next month, which I think is going to create uncertainty as to what happens, if he is not able to govern. So that creates uncertainty for the US markets. It also gives the opportunity for Russia and China to further flex their muscles. So I think if we looked at the, bearing those roadmaps of the 20, 60 and 80 year cycles, they also saw quite a sell-off into at least June and July. So that would be a long-term guess, but here, we trade the market. So we look at what happens every time we come to a significant turning point, and we evaluate it appropriately. So if you're asking me to make a prediction, my view is that we are probably going to make a pullback in the next few days, then look for a further move down, possibly a significant move down if we see a degree of global geopolitical instability, and then towards the back end of the year, a bit of a rally. But it should well be that the case is that 2022, well, years ending in 2 tend to see major lows. So, and then we tend to head up out of there.
Okay, can I pick up on that point about Biden and where you get this from? Because this is an interesting point to mention. You talk about a point of interest, obviously it would be. Just dig a little bit deeper if you can about the Biden comment you made.
Yeah, so what we do is we keep a whole series of roadmaps, not just on markets, but also on geopolitics. And the idea really is that America's under a lot of stress as a global power this year. Now, this is just the empire framework, as it were. This is how all empires, rise and decline. And within that, there are some patterns of presidential incapacitations, is probably the best way to put it. But, if you look at that, there are things that suggest that February is a close point when we tie those. We have a proprietary cycles analysis system, which is what I've shown you in the histograms. We can also apply these to geopolitical events, which is a very complex procedure, and that's what we do with our programming system here. And it's that reason that suggests that February is actually a very key month, and actually there are 3 key trigger points for America, and February is one of them. And I think whatever happens is going to have ramifications in July, which also ties up with the market timing cycles. We're likely to see a resolution towards the back end of the year in December. So it's quite a complex setup, but it's all based on mathematical profiling. And, Kennedy was assassinated in 1963. That's the 59 years away. Next year will be the 60-year cycle. So we're close enough to seeing something like that. Now, let me just make it clear, I'm not saying Biden's going to be assassinated or anything like that. But no. we do see these patterns play out with great interest.
Interesting. Let's get back, if I can, to ask you the question more about how you prepare things and this market timing report. Explain more about what it does and what it offers. Obviously, you've got these trigger points you talk about. Give some more depth and analysis about your software, how you apply it, and how you publish it in usable data.
Certainly, yes. So the whole idea was that, we were really just using it for our own trading and investing, and we do run a portfolio with this. And because we've got this unique system of timing, people were approaching us saying, can you give us the information, just the timing dates? And initially, this just went out to a handful of significant hedge funds. And what happened then was that so many people asked for it, so we made it into an affordable monthly publication, where we look at the timing points on S&P, crude oil, gold, dollar index, euro, and now more recently Bitcoin. But not only that, we then put it into the context of, we give some technical analysis around it, what geometry we're seeing, what pitchforks, what trend lines, etc., and where the support and resistance levels are going to be. But we dive a lot deeper. So we also, there are certain high probability days across certain markets. And what happens is that every now and then you'll find a huge monthly cycle coincides, it has a weekly cycle with it and a daily cycle. And that way we're able to identify significant trend changes. And that's exactly what we did, back in February 2020. So we were able to identify the top of the market very clearly. And just to give you an idea, the 1929 crash, which people will have heard of, there's a 90-year cycle in markets, and you can go back 90 years before that to 1839. 1837 to 42 was a huge collapse in America and British markets. And so projecting ahead to 2019 suggested we were going to see some sort of high. Well, we were only, within a 90-year cycle, that came in just 6 weeks out. So that's a good enough tolerance to work within that. There are other cycles, back in 2018, all the way through to 2020, we forewarned of a pandemic. based on 100-year cycles, because there have been significant pandemics. 1918 saw Spanish flu, 1818 to 1821 saw the cholera pandemic, first cholera pandemic across Asia, Europe, and North Africa. And then we saw two smallpox pandemics in 1618 to 1620 and 1720 as well. So these cycles move with absolute precision. So we put the geopolitics in there as a background. We provide timing on the markets as well as sort of, geopolitical views and the technical analysis. And the idea is it's there to give you a bit of an edge. And what we do is most people have their own trading and investing systems, but we've also created one that works very well, for those who don't have it. So we had a lot of readers that said, well, how do you trade this? So we now teach them how to do that as well.
Andy, look, it's an interesting subject. Thank you so much indeed for your time, and interesting to look into your thinking around cycle analysis. That's Andrew Pancholi from the Market Timing Report, or MTR.